Pick n Pay was founded in the Western Cape by Raymond Ackerman way back in 1967.
Okay, although Mr. Ackerman is now retired, Richard Brasher is the CEO. Remember, he's an ex-Tesco guy, and to be fair to them, they had a very poor time about 5 years ago, but since then they've been regaining market share and improving margins. The market's been liking that.
Market cap 30.7 billion rand, PE of 33, and a dividend yield here of just under 2%.
Let's have a look at that share chart, because,
well,
you know, if you'd hated them, well, I suppose it hasn't really shot the lights out, but it has moved.
Well, it's holding up. I mean, Chantal, what do you think? It's holding up.
Yeah, you can see that little dip at the end there. That's in response to its recently released numbers, where they actually saw a contraction in operating margin for the first time in a while. But it is a bit overdone that price moved back.
What did they point to for that contraction in margin?
Other income. So they saw a reduction in other income, which is basically when you go into Pick n Pay and you stand there in the aisle and you see those iTunes vouchers and you decide, well, I'm going to get some airtime, those kinds of things. They saw a reduction in sales from there. So that other income story really weighed on their operating margin. But surprisingly and well done for them, they actually managed to maintain gross margins, even though they've been under a lot of pressure because of this weak consumer environment.
The story has come to fruition, and as you say,
Yeah,
Richard
because
Brasher
when
taking this
Mr.
from strength to strength.
When Mr. Brasher arrived, they were in tough trouble. They had outdated distribution systems. Their distribution centers, if they existed, weren't running all that well. They had stock problems. All their suppliers hated them. They had bad IT. They paid their suppliers late. There were drama in the stores always, with lots of labour action, one way or another.
So a big challenge when Richard came into the job.
But the interesting thing about how the market has responded to that is that even though sales were terrible and the profits were low and the margins were bad, the share price was always expensive, almost as though the asset management community was already buying the recovery before it was delivered.
Chantal, do you buy into what Paul's saying there?
I agree, and I don't think that the recovery has been fully delivered yet. So I think that share price is being sustained by the expectation that the best is still to come. I mean, you've seen some gross margin expansion, some operating margin expansion, now again the contraction, but not because of the core operations. So I mean, if you are still in the camp that believes that this margin story will materialize, you'll see some good leverage through to the bottom line, and that might justify this pretty high rating.
But
But when is it going? But when is it going to happen? And I think this last result was a big disappointment to the market. I did mention earlier that I think it's a little bit overdone, but still it will concern investors.
And again, and you know, the dividend yield comparison, if you look at SPAR, where you've got that robust 4%, here you've got under 2%.
Yeah,
so
which
not
is
compelling.
Yeah, which is more or less in line with the rest of the market. I think the SPAR and Woolies dividend yields are actually they're a bit out of kilter with the rest of the grocery space. Pick n Pay used to be a very attractive dividend payer, but of course when they ran into trouble, they had to cut that back a bit. Who knows? You might see the board reconsider pushing up that dividend yield through dropping the cover a little bit in future. I don't know.
Hot or not, Paul?
you know, I feel a bit stupid as I sit here because I've been calling this one not hot for the last 7 years, but
don't tell me you're not going to change your mind and call it hot.
I think I'm going to stay with
Chantal's
not hot.
cautioning. Okay,
because
good.
I think the share price has already priced in a great recovery, and if there's been a little bit of concern about the continuity of the recovery turnaround, well then we ought to be worried about where the share is trading. So not hot.
Not hot.
Well, to me, it's a bit expensive as well, but I still think it's hot. I still think there's lots of potential for that nice margin expansion.